All right, folks. Hey, welcome. It's great to have you here. It's certainly great to have our guest, Andy Wiederhorn, with us. Andy is the CEO of Fat Brands. As you've seen him tweet and me tweet, there are a lot of brands that you guys know, and obviously right at the epicenter of some of the pain that has come down because of uh, COVID-19. And I think Andy's got a great optimistic way of not overly sugarcoating it, Andy, but certainly you have an optimism about the operation of these brands, which is from Ponderosa and Fatburger. I love Fatburger, by the way. I think
Thank you.
that is, I remember the first time I was ever in a Fatburger, and it was a great experience. Any of the make your own burger kind of places, I end up sort of, really appreciating to have it
Right.
exactly the way I want it. But folks, let me welcome in Andy Horn, again, the CEO of Fat Brands, and we're going to talk about uh, exactly what's going on in the markets, talk about what's coming out of Washington, D.C., and so forth with Andy. So, with that said, Andy, thank you for joining us today.
Thanks for having me.
We're really looking forward to hearing about, just to give you guys an idea, folks, this is everything from Fat Burger to Buffalo Cafe, Buffalo Express, Hurricane Grill and Wings, Elevation Burger, Yala Mediterranean, Ponderosa, Bonanza Steakhouses. You guys have heard of many of these brands, I'm sure. And if you're running 375 units worldwide, this had to be just a gut shot for you guys, Andy, to have all of a sudden as many of these restaurants close down, even though, of course, some of these are franchisees, but that still hits you and your heartstrings because of the investment those folks have made.
Yeah, it's definitely a pain in the neck. Not something in the beginning of March we thought we were going to be dealing with at the end of March or after that. We have these 8 different restaurant brands. They're in 20 something states around the US and 20 something countries around the world. About 100 of them are in Canada and in Asia and Europe, and the balance in the US, so about 3/4 in the US. And it's hit them all very hard. And every single one of our restaurants is a franchise. So I have a unique perspective that our customer really is the franchisee. That's who pays us every week with their royalties. It's not really the person eating the hamburger or the steak, even though, of course, we treat them as a customer as well. It's our franchise partners. And it's very important for us that we get them back up on their feet and get their restaurants open, and that we give them coaching advice how to navigate through this environment.
Right. Well, and that has to be extremely helpful and much needed at this time because you guys probably have more of a staff that is able to help them when they're doing things like, I'm not saying you're doing it for them, but perhaps you can be somebody that they can talk with about getting that small business loan, and about how they could go about which banks would be the ones that, hey, if these guys are the ones that process all of your transactions, or if these guys are one that you have mortgages with, here's the way that you should go about that. Is that kind of information you would share with some of those franchisees?
That's exactly what we did. As soon as this happened, we started coaching the franchisees, talking to them 2 or 3 times a week, communicating with them in writing and having calls brand by brand with them, having a crisis management team amongst our executives every single day and our board every single week to plan for this. And then we've been giving them advice about how to apply for a PPP loan. And we had them all ready and everyone applying on the first day they could, how to apply for the SBA economic injury disaster loan, different kind of loan, also as quickly as possible for their business and for us as a brand to help them, if we can get those loans, to start giving them marketing dollars to restart their businesses. So that's one thing on the government sponsored programs. But then we've also coached them about negotiating for rent deferrals, talking to their landlords about trying to get 3 months of rent deferral, and planning with the food suppliers to get them better terms, because most of these guys pay their food supply on a 30-day basis. But if they haven't had any revenue in 30 days, how do they pay that bill when it comes due? So we tried to negotiate better terms for them, like 6 months to pay the 30-day bill, and maybe they pay for new orders on a 7-day basis, things like that. So generally, we've tried everything we can to coach them into financially getting ready. And then you've got the operational issues and the service issues that customers are going to expect.
Right. Well, obviously, for instance, today, Andy, we saw a big rally in the markets. And one of the sectors that I love, is your sector. Consumer discretionary plays, whether it's Darden, the amount of restaurants that they have, or whether it was Cheesecake Factory or Brinker Eat. These are all names, folks, or symbols in some cases of those brands that are publicly traded and so forth. And they were making monumental moves today. And one of the reasons, obviously, was Dr. Fauci, who has kind of become everybody's, Dr. Marcus Welby or whatever. It's a guy you trust, right? Because he doesn't, I won't go political here, Andy, but for any of the hyperbole that is around this particular disease, he seems like a very calm guy who, when things go the wrong way, he's going to say, okay, we got to stop this. We got to start getting more distance and blah, blah, blah. But the rest of it is all just very thoughtfully presented. The guy doesn't even have a voice anymore. I mean, right. In a week, I don't know how he's going to speak.
Right. Brad Pitt won't even be able to imitate him then because he'll be right.
Yeah. I mean, but he has been doing a great job advocating for, we all know, though, on the other hand, that, and I think that's some of the optimism right now about, whether it's from Ponderosa to Fatburger, there's an optimism that things are starting to open up. But obviously, the industry still needs an awful lot from government. So one of the reasons that we thought it would be great to talk with you, Andy, is that you'd have some insights perhaps into, even after we've had this monumental stimulus package, short term, it's city by city. Obviously, the biggest impact in the whole country, and for the most part, it's bigger than Lombardy, Italy. It's New York City. And I'm not saying, oh, this is where the concentration of your brands is, but it really is a city by city issue here as far as how these operators can get back up and running.
So true. And what's interesting is, we have different types of brands. We have fast casual brands or QSR-like brands, and then we have casual dining brands. And they're going to be very different in different markets and in different weather conditions also, although pretty much everywhere we're entering into the spring or summer. And so I think city by city, like Georgia opened and Greater Atlanta opened up on Monday, and we have a number of Buffalo's cafes in that area, and they've bounced back quickly to big numbers where they're doing almost 100% of what they were doing to start with. Now, I don't know if that's sustainable, and it hasn't been a full week, but there isn't anyone who's going to say that people aren't itching to get out and be able to take a walk, get something to eat, go about their what used to be their normal lives again. On the burger side, we had such a spike in delivery and to-go business. We went from what was normally 40% of our business to 62% of our business. So very, very resilient, only off therefore like 28%. But, people, there's also a cost to delivery. It's not quite the same, right? There's all the delivery service fees. The operators get compressed in their margin with those fees as well, because they're paying for part of that cost. So I think as we adjust to this new norm, you're going to have consumer behavior, you're going to have consumer pricing, and you're going to have the realities that some cities, for California, for example, is probably going to take longer to open than Georgia or Texas or Florida. So operators are going to be affected differently, and the stimulus will run out in those markets.
Yeah, the stimulus will run out in, I'm a guy, Andy, you might not know it looking at me, of course, but I've owned 3 different restaurant groups. Not the entire group, but I've had fine dining. It was great. I ate great. I didn't make a dime.
Tough
not
business.
A dime.
Tough business.
Yeah, because you've got these chefs that want the perfect pepper or whatever that they're going to carve out into this beautiful, the circuses that these guys care about. I care about it too, but I care more about the food. And when I'm the owner, I care about the profits. Um, then we had a second one that was a breakfast spot. I thought we couldn't lose with a breakfast spot. Nope, lost with that one too. The only one I've ever made money with is a Mexican dive bar. And we crushed it with this crazy, it was called Cactus. So it was always man versus margarita. So if you ever want to put up one of those franchises, let me know. I'm sure we can talk. But it's a great, it was a great concept because people would show up after work primarily. We'd have a good lunch crowd, but they'd really show up. It was for traders, Andy, because I'm a trader. I started here in Chicago in 1981, had a career that ran through like 2004 as a floor trader. And all of those men and women, they're done at 3 in the afternoon when the market closes. So they're ready to start enjoying themselves. So we were tequila, beer, full liquor bar, but
Perfect.
we mainly sold chips and, quesadillas and things like that. But we crushed it.
Well, day parts are really important, right? Because you can't just sell burgers at lunch. You can't just sell food at breakfast. You have to be able to sell it at all different times of the day to pay the rent. And that's always why it's tricky. In fine dining, you have to do big volumes. You have to own it and operate it and live there, really. And in the other brands, you've got to have these other day parts to help get you through it. And just for you, we opened a ghost kitchen with Fatburger in it in Chicago on Monday. So you can get it on delivery from now on in Chicago.
Now, Andy, I know what a ghost kitchen is, and anybody in food service knows what it is, but please tell the listeners and viewers what a ghost kitchen is.
Yeah, and let me just give you some examples. So co-branding, we all know what that is. That's where it's two brands in the same restaurant. You have two signs outside, one counter, one cash register, maybe two menu boards and one kitchen, and that's called co-branding, where you can have, tacos and pizza, or in our case, burgers and wings, two different brands, Fatburger and Buffalo's Express. We have about 100 co-branded locations. Then there's a ghost kitchen, which is a remote location for delivery only that can hold multiple brands. And there's one more concept which you're going to find interesting, and that's called a virtual restaurant. And that's where we're selling in some of our restaurants a third or a fourth brand for delivery only out of the back door. So you might get Fatburger and Buffalo's Express if you walk in the front door. But if you also want Hurricane Grill and Wings or a Mediterranean concept, Yala, you can get it for delivery on the platform as well. So very interesting to get franchisees more volume to sell out of their kitchens. And a ghost kitchen operator doesn't build a brick and mortar restaurant. They go into a commercial kitchen space and they can operate multiple brands for delivery only. You can't go in there and buy anything. You can't sit there. You don't even know where it is, other than maybe proximity for delivery. And so that's going to be a very interesting model to see how that develops throughout the US as well.
Right. So, and that seems incredibly innovative. I mean, the ghost kitchen is one thing, but then that virtual where you, like you say, you're running multiple brands. So in other words,
about 25 of them now. In the LA, we tested it for a year. And so if you go on to Uber Eats or Postmates or DoorDash or something, and you want to get a Fatburger or Buffalo's Express, which are brick and mortar co-branded locations, you'll also see when you look up wings, it'll come up under Fatburger, it'll come up under Buffalo's Express, and it'll come up under Hurricane Grill and Wings. And it'll have the different sauces and the different packaging in the back for Hurricane Grill and Wings. But we're giving that operator $1,000 or $2,000 a week of incremental sales. And in the restaurant business, as you know, those last sales, those last dollars in the door are all profit. So it's important to boost average unit volumes. And that's a great way to do it. Even across our Ponderosa and Bonanza steakhouses, we're going to implement more virtual restaurants because you can't keep those seats full all day long. But customers that are now accustomed to go are going to be looking for those brands.
Now, Andy, my brothers, it's not like we're a fast food family and a franchise family, but we owned a number of franchises because when I came to Chicago, I tasted this Popeye's fried chicken.
Sure.
Thought it was fantastic. Brought it up to Minnesota every time I flew home. My brothers eventually opened like 4 or 5 of these Popeye's chicken franchises, had the number 1 and the number 3 of all of them in terms of revenue for a number of years. But what I'm curious about is if you've got that virtual kitchen and the ghost kitchen concept, and you've got a virtual kitchen, what do you charge that franchisee that is out there, you know, so he or she does a franchise with you for a Fat Burger ghost kitchen or whatever. And then all of a sudden you say, hey, would you like to be running some wings out of here too? And it's X amount more, you know, because everybody knows that there's a little bit of the franchise fee that goes with every sale, obviously. Tell me about how that works.
Yeah, so normally like a franchisee will pay us somewhere between $25,000 and $50,000 for like a 15-year franchise license, an agreement to be a franchisee. And that comes with the training and setup and building of their store and all the things that we do to help them. But then they also pay a royalty, usually 5 or 6%, depending on if it's sit down, casual dining is 5%, or fast casual, maybe 6%. And so in our effort to help our franchisees build their sales, build their average unit volumes, we're not charging extra franchise fees, upfront fees to add our virtual brands. We just want to help them grow their sales. We're going to get our royalty either way. So if they can sell more, we're going to get our fair share, but we want to give them every tool possible to make as much profit as they can per unit to pay their rent and have money to take home. And you know, I'm a finance guy running a restaurant company. I'm not a food guy. And even though I love my Fat Burger a certain way, like you remember making yours, you know, I'm focused on how does a franchisee make money? Because if they don't make money, we know what happens, right? So I have to do everything I can, lower their food costs, teach them every trick in the trade to manage their business and their menu mix and their pricing, and give them more things to sell without confusing the brand. So if you have a virtual restaurant concept, look, your Fat Burger menu's simple, your Buffalo's Express menu's simple. You don't even see the menu for the virtual concepts. They're on the delivery apps as a separate restaurant. You don't even know it's coming out of the same restaurant.
Fantastic. Now, by the way, kudos to you guys. And maybe if you wouldn't mind just telling the audience, you were providing meals for healthcare workers from at least Fat Burger and maybe from other franchises as well. But that was the one that I saw. Tell us a little bit about that.
Yeah, you know, trying to figure out how can we help here in a situation where everybody's getting their butt kicked. We have a mobile food truck in Los Angeles, so we decided to donate 10,000 meals to the relief workers at the hospitals and any of the professionals. And so we're donating about 500 meals a day over a month, 20 working days. So 10,000 meals. We went to all the different hospitals, 2 shifts a day, gave out burgers, fries, and drinks. And we're just going to increase that to a total of 25,000 meals beginning on Friday. So for the month of May, we'll give out another 15,000 meals. And, you know, look, those first responders are working so hard and tirelessly in just, you know, in the toughest of conditions. So if we can give them some burgers and something other than the cafeteria food they have to eat, we're happy to do it. It gets brand awareness for our franchise partners as well. So it's just a good use of money. In Florida and in Georgia, where we have Buffalo's Cafe and Hurricane Grill and Wings, we've been donating platters of wings and other fries and stuff to the police and fire and some of the medical centers as well. And of course, you know, everyone's happy to get it. So it's just a drop in the bucket, honestly, compared to what everyone else is doing, but at least we can do something.
Well, hats off to you for that. That's great work. Yeah. And I'm sure that goodwill that you build with those folks will come back.
There are customers also, right? There are customers too.
You bet. You bet. So one of the things as I was researching Fat Burger and Fat Brands is that you guys have actually at least expressed through either Restaurant News or some of the other magazines that I was looking through, you guys are potentially a buyer, that you say you're being pitched, you know, whether it's a concept from a guy like me that says, I got this great cactus that you should buy from me. And,
I'm calling you afterwards about that.
Exactly. But you're being approached by a lot of folks who either might be forced to make such a decision, or they just realize that, especially in these times, they need somebody with deeper pockets than they've got to get them through. Tell us a little bit about, I saw a number, I'm not sure if it was accurate, $1 billion or more that you guys have raised and specifically targeted for some of these kinds of purchases or vertical integration.
We were really fortunate, I mean, John, really fortunate to complete a whole business securitization like the week before the world fell apart. Like on March 6th, we completed this BB rated deal from DVRS Morningstar as a securitization of our royalty stream, and gave us with a lot of liquidity and enough to sort of survive through this. And we have access to raise more capital through it because it has an add-on feature like an accordion. And so, we're in the middle of some acquisitions, which we put everything on hold to try to hunker down and figure out what the world was going to look like. And now, as things have calmed down a little bit, not that much, but a little bit, we think that those acquisitions can continue, and we think there's opportunity to buy more brands. And as you said, look, some are going to be distressed. Some just want to be better capitalized or want to hang up their towel and do something different. And so, I don't really look at it as we're trying to go hunting at rock bottom prices. I think a better way to approach it is to say to operators or to private equity or to sellers in whatever regard, look, this is an unusual period of time, so you can't really measure normalcy. I mean, we can look at what last year is, and we can probably get a pretty good idea of what normal is. But as we go forward, we don't know if people are going to go back to 75% or 80% of what they did before, or what the number is going to be. So I've tried to approach some of these acquisitions by saying, let's agree on a formula, whatever that formula is. Maybe whatever the rate we were going to pay you last year, great, we'll apply the same rate, but we'll measure it a year from now. Let's not measure it right now. And find a way to make a deal now where we can take some stock, some cash, some whatever, but we don't want to overpay. And I don't want the reputation for like rock bottom, picking them off when they're in trouble. I'd much rather make it a fair situation where someone can say in a normalized time, here's how my restaurant's recovered. Okay, we'll pay you that multiple based on whatever it recovered to. And I just think there's a huge opportunity for Fat Brands to acquire another 2 or 3 brands during the course of the year and leverage our platform. Because when we buy these brands, we already have the accounting department, the legal department, the back office, everything to absorb these. And these are franchise brands I'm talking about, not stores. And so it's very easy for us to go in and we might pay 5 or 6 times cash flow, but after the synergies, we're really paying 2 or 3 times cash flow. And it makes a lot of sense for us. We can get a good number in the hands of the seller. And I think that there's just going to be real opportunities over the rest of the year here.
That's great. I mean, believe me, many of us think that there will be consolidation. You see any of the beaten up spaces, for instance, the folks that come to mind right away are oil and energy, and people worry about that. And of course, until they actually sustain a steady level for crude oil and or natural gas, it's going to be a pretty tough sector. But yours is a different sort of thing because you don't have the overhang of all that supply. Instead, you've got a lot of demand that would love to get out. and we can't wait for when we can get out. I mean, I'm still practicing social distancing, but I am rooting for a thoughtful reopening, I'll call it.
Right. Who is it, right?
Yep. Because I think it's important for us mentally as well as to get out with our fellow man. How about switching gears just a little bit? When you have these delivery companies that you cited, whether it's with Ghost Kitchens or just a regular Fat Burger franchise or whatever, when you've got those, some of those are taking a pretty big bite of the profits, or at least maybe not even of the profits, but they knock the profit all the way down because they take such a big piece of that overall bill. And I'm not saying it's DoorDash or Grubhub or Postmates, I'm Seamless, I'm going to name them all. I'm just saying, I'm not sure which ones are good players or bad, but how do you guys deal with that? And you see certain areas, certain metropolitan areas like San Francisco, where I was born, that are trying to put a limit on how much those delivery companies can charge.
Yeah, well, let's talk about that. And let's also talk about what maybe the other stimulus measures might be to help make up for that. And just on the delivery side here, a delivery company might charge 20 to 30% and from the operator out of their pocket. And then the customer may or may not get free delivery or may have to charge, they pay a fee for delivery. It depends on the service and what environment we're in. But traditionally, we would coach our franchisees that this is still incremental profit to you, because if your food cost is 30% and you're only getting 70 or 80 cent dollars because you're paying the delivery company a fee, you still have a lot to work with. You don't really have incremental labor because those employees were already in the restaurant working anyway. So they have a few more burgers or wings to make or whatever. It's still a profitable sale for you. But if you go to free delivery and the delivery company says, well, look, restaurant operator, we're not going to make it free. You're going to have to pay for that. Or you have a shift in your mix. And so if 70% of your business was cut into your restaurant, getting to-go food or eating in the dining room, and you didn't pay a delivery fee, and you only paid a delivery fee on 30% of your business, well, that blends out, to only be a few points across the board. But if now your business shifts to where it's 40, 50, 60% delivery or, to-go food, and you're paying that much bigger spread across the whole revenue base, now you're getting squeezed to where you're not making any money. And so, I always say when people argue for higher minimum wages, great, who doesn't want their employees to make more money, but who's going to pay for it? Because it's not free and you can't expect the owner operator to absorb all these costs. So I think what's going to happen here is in this shift of consumer behavior to either social distancing or table spacing or more delivery to go than dine in, you're going to have more costs associated with that. And that's going to cause prices to go up. I think it's just a reality and people have to get used to it. It's not reasonable to think the operator can pay for it, but it's something that you're going to have to expect until, if we ever get back to 100% of normalcy, there's going to be a cost there that gets passed on.
Right. Well, again, leaning on my minimal experience, I know that just like a jet, if I can put in an extra row of seats, if I've got a successful restaurant, those extra seats mean money in my pocket. Like I say, that's based on me having a successful brand that is bringing in people anyway. If I can flip that 4-top or 2 more 4-tops 3 times in a night, like you said, Andy, that drops right into my bottom line. And yet now we're in a situation where some of these restaurants, spacing at 50% of what it was before, that makes that delivery all the more vital for these guys, because otherwise I could never, as much money as we lost in those fine dining or the breakfast place, we would have lost more if we had to space everybody at half of what the fire marshal let us have in the first place.
Yeah, it's so true that it's going to change the product mix, if you will, of the delivery of service to go. And we went from 40% to 62% on the burger side, right? So that means 22% more of sales. Now you're paying a delivery provider for. And let's think about something else. If you look at the car chauffeur services like an Uber or Lyft or whatever, none of those guys seem to make money and they have so much market share. Okay, have the food extensions where Uber Eats, Postmates, DoorDash, whatever. Some are making money, some aren't making money at Grubhub, right? You look at them and say, okay, how can you guys have so much market share and still not make money, right? What's going to ultimately have to happen to make money? There'll be consolidation, but there'll be price increases, right? Because I don't think they're all losing money because of competition. I think they've underpriced their product. And so there really is a cost here that they're just going to have to deal with.
Well, I agree. And an awful lot of those, it's interesting. We look at this alternative data all the time, Andy, when we're trying to trade stocks. And some of that alternative data is, okay, which websites are getting hit? And is it more this month than last month, more this week than last week? I don't ultimately know how much, unless they've got, the people that opt in for email receipts, then I know. If I'm buying that data, then I know. But if they don't opt in for the email receipt, I only know that Postmates, Seamless, again, DoorDash, Grubhub, all of these different services, I know how much has increased in their traffic, and then I have to sort of calculate how much that's actually resulted in additional sales for them. Now, as far as you guys adding franchises or locations, you're still in the mode that you think you'll add 20 to 40 this year?
Yeah, we've opened so we opened 11 so far this year, And we have 3 that are ready to open as soon as the cities allow them to open. And we have with 25 total, I think, under construction left to build this year. Now things have slowed down timing wise, schedule wise, city inspector wise. So I don't know if we only get 15 or we get 20 of those 25 open in the remaining 8 months of the year. But we are still seeing franchisees build restaurants, continue to come in and buy new restaurants. We're just doing a deal in Fresno for 3 more restaurants today, or in Stockton, another one. We just did one on the East Coast. So we have a lot of activity. We signed a big deal in China to roll out more fat burgers across China and our Elevation Burger brand. So, I think I don't think people have lost sight of life needs to go on and commerce needs to go on. These boundary restrictions that we're all dealing with, what will end up being consumer behavior or employee behavior, will have to adapt to make consumers comfortable that they can still eat in a restaurant, buy food safely from a restaurant, and the operators will have to deal with it, whether it's masks or gloves or whatever, spacing the tables. Consumers are not going to stop eating and want to cook at home all the time and want to have their children at home all the time, not in school. It's just not it's not going to work. So we have to adapt to it, and that means I think our operators understand that they're going to build more restaurants.
Gotcha. Now, in the final couple questions I've got for you, Andy, what about openings as they start to roll out here? I mean, you mentioned Georgia because, of course, the governor was in the news for saying, that he was pushing hard to get them open. Obviously, 8 states never closed in the first place. But the ones that did close and are trying to reopen now, what are those reopenings you think going to look like? Is it going to be just what I said, that it'll be 50% capacity that will be the maximum that they let in? Or will it also be that the servers are wearing masks and gloves, like you said? Is that what you think it'll look like?
So I do. I mean, I think that consumers are going to demand PPE equipment, personal protection equipment, the masks and gloves and stuff from the servers. And frankly, I think the restaurant employees are going to demand it from the customers who are standing in to-go lines and things like that. But I think that will be in place until a vaccine is out there, or until some sort of therapeutic that kills this off is out there, and they can feel comfortable. And then we'll have the shot going back to completely normal. But until that time, there's going to be that behavioral shift, and people have to be ready for it. I mean, look, you're going to have 50% dining capacity in many places, but that just means the balance, as much of the balance as possible, knock on wood, will get picked up by delivery and to-go food. And that's what we want to promote. So we've tried to come up with advertising campaigns for our franchisees and our brands to say, look, as soon as you can open, we're going to push marketing that conveys all those messages to our customers, that our employees are safe, you need to be safe, we have delivery available, you pick what you want to do, but don't stay home and cook on your stove. Take advantage of supporting your restaurants, changing it up a little bit and trying to move this thing forward.
Great advice there. My last question really, Andy, is about your idea, which I think other people have had that idea, but what I read from you was that you thought that this payroll tax, that if indeed the government would refund the payroll taxes and base it on a head count and all that sort of stuff, that if they would do that, that'd be a very smart way to get a lot of these businesses through the tough time that they're in, with whether it's a 6-week shutdown or a 2 or a 3-month shutdown, and get them to the other side. Can you elaborate a little bit about that?
Thanks for asking me about that. I really appreciate it, because I think that message needs to be heard. When these restaurants ask their landlord for a 3-month rent deferral, and most landlords are giving it, most landlords are very reasonable, even though they have their own mortgage or their own CMBS lender to pay, as we know. What's going to happen when they reopen? They still owe the 3 months of rent. How are they going to pay that? They're supposed to be spending the PPP money on getting their employees back to work and getting their restaurants open and ordering food again, because they had to throw out all the food that got wasted before. Depending on the city, if you're not opening up right now, which has been 6 weeks, and you've got to wait another month, those PPE loans aren't going to cover you through that. And you've got that 3 months of rent deferral you're going to have to pay at some point over the next 12 months. It's not going to be longer than that. We all know that. So I think that refunding the 2019 payroll taxes that employers paid just makes such a, it makes so much sense because it's so pro rata. I mean, if you paid in because you had 100 employees or 500 employees, the government knows what the number is because you paid it. You filed your payroll tax return, they have a head count. There's nothing to verify. You don't need the SBA and the banks to be jammed up trying to push it through. You know the employer's bank account number, give them back their 2019 taxes. It's a 7.5 to 15% number. And that would be a nice shot in the arm to get them going again. And I hope that they consider that because they just think it's an easy way, pro rata, to push it out. Look, if not, we'll have to see that PPE has to be calculated a longer period of time, or they have to fund the FDA economic injury disaster loan with more capital. But I just don't think that the current stimulus dollar amount, and it's a huge amount, we both know that, as it relates to small business, even at $600 billion, is quite enough given the duration that these operators are going to face and the limited or the distancing that you mentioned a minute ago. I think they need a little bit more help. I don't think that's a secret to the Treasury Department or the government, but we probably need a little bit more to get them going.
Cool. Well, I love that, Andy. And you're showing why that you could also be wearing that CFO hat, being a finance guy as you are. But I really appreciate that. That's great advice. And hopefully we can get that message out there. Folks, I've been talking with Andy Wiederhorn from Fat Brands. He is the CEO. And Andy, I really appreciate your time. And I love what you guys are doing, helping feed these healthcare workers and cops and firemen and all the folks, that the first responders. So thank you for what you're doing. And I wish you a lot of success in 2020, reopening these restaurants and growing them.
Jon, thanks for having me. I appreciate you guys listening to my thoughts.
Thank you, Andy.